Welcome back to our very special strategy design module. And we'll just get right in. What is it when we talk about strategy design? And what are we going to do in this module? And the idea and the definition as I see it is the process of designing a framework for a new trading strategy, then testing the strategy, back testing to see the performance on historic data, and then taking it in the live markets if it makes money in a back test, and we can verify its profitability. So basically, we want to create new trading strategies, then we will back test them to see if they would have made money in the past on historic data, and then we will take them live if they have made money in a back test and see do they perform profitable in a live market. And the process that we're going to follow is this. First, we're going to talk about idea generation. How do we even find ideas for new trading strategies? Then we're going to do a definition of all strategy components, what we've done in the past with entries, exits, stops, targets, scaling in, and everything else. Then we will take the strategy that we have defined. We will backtest it in historic price data. We'll do that together as well. Then we're going to analyze the results to estimate, is the strategy idea profitable? Is there something, even if it's not profitable, can we improve that? That is in the next step, adjustment process. So we're going to take a look at the results and then adjust it to make it hopefully more profitable. And then if we have found a strategy that is profitable in a back test, we can forward test it, which means we will take it to the live markets, preferably first on demo. Then we could think about taking it fully live, which means risking real money trading the new strategy. And the goal is that we will develop new trading strategies that can complement our portfolio so that maybe we end up with multiple trading strategies that complement each other nicely. And the first step when designing a new strategy is the idea generation. And here we just want to come up with as many trading strategy ideas as we can. And here anything is really allowed. Here you can't do anything wrong. We just want to come up and brainstorm lists and ideas for strategies that we can later test. And this is often the most creative step. And it's very important to understand that there's no right or wrong at this stage. You have to just get going and just start creating strategy ideas. And this is like a muscle. The more you do it, the easier it will be. I have some tips in a moment. And what I personally do is that I have a list on my phone, but also have a list on my computer. And whenever I have an idea for a strategy, I fill the list with ideas, and then later I will come back to evaluate it. And if you have problems with idea generation, luckily there are so many resources out there. And if you don't have any ideas, you can go to Twitter, follow some of the famous traders, follow some of maybe the high profile or low profile traders. You can read trading blogs, listen to trading podcasts, look into trading forums. There are millions of YouTube videos for trading strategies. There are countless books where trading strategies or at least ideas are shared. And there are so many resources, and you should be easily able to come up with dozens and dozens of ideas over time. And this is what I personally do as well. And the strategy that we are going to test later on came from a YouTube video. I was exposed to an idea that another trader shared, and then I found it interesting, and I decided I want to test this as a strategy. And you can do that the same with books or podcasts. There are so many podcasts out there where traders share their strategies. You don't need to have a fully formed strategy in a book or a podcast or YouTube video. You just want to have a general idea to get started. And for ideas, there are really no limits. As you have seen during the last few modules here in this course, I've explained so many chart concepts, tools, indicators, and so many different ways of how we can analyze the market that there are just so many countless ways of analyzing or building strategies. We can use overbought, oversold. We can look at weekend gaps, fake outs, fail patterns, candlestick signals, broader chart patterns, divergences, sentiment, moving average crossovers, pullbacks. We can look at previous day breakouts. We can look at previous day reversals, Fibonacci's, Bollinger Band spikes, and so on. The list is ongoing, and we have so many tools that we have started to learn here over the last videos. And during the process, when we are doing it in the next video, designing our own strategy, I will show you exactly my thought process, and hopefully it will help you. What we also want to do in this first step is we want to think about what is the objective of the strategy that we want to develop? What is the goal that we would like to achieve? For example, how many trades would you have or would you like to have? This is determined by the time frame. So you can think, do you want to be or do you want to have a strategy that is more like a day trading strategy where you have multiple trades a week? Or are you looking for a long-term strategy where you maybe have only one trade a week, one trade every 2 weeks, maybe 2 trades a week, where you hold them for a long period of time and you are as a swing trader on the higher time frames? That's important, obviously. We need to know that. How much screen time? This is defined by your time availability. How much time do you actually have? Can you trade a day trading strategy if you have a very busy day job? We also want to then look later on at the win rate and reward risk ratio trade-off. I will talk about this in a little moment more. Also, holding time. Do you like to hold your trades for a long time, or do you want to find a strategy where you have no overnight exposure and you're always flat at the end of the day? That's also very important. So when it comes to the time frame choice, I think there are a few questions you can ask yourself. Do you have time during the day? Yes or no? Are you impatient generally? Do you avoid holding trades over the weekend? And are you generally nervous with open trades? And then you can see, depending on how you answer, do you fit into the day trading category, or are you more of a swing trader and should you look for a swing trading strategy? Of course, this is just a guideline to give you some idea of what to look for and what to ask. Step 2, once we have our rough idea, we have to fill the complete strategy framework. So we have to think about what defines our entry, how do we set stops, how do we set targets, do we scale in and out, yes or no? And all of those components we need to define, because those are then helping us do the backtest. If we don't have rules, we can't do the backtest because we don't know what we're going to trade. And you can choose a framework. For example, when it comes to entry rules, you could think about, okay, my strategy, my entry could be made up of a higher time frame idea, a lower time frame idea, and then how do I get into the trade? For example, you could look for a higher time frame support and resistance level and wait for the price to get there. Then you can drop to the lower time frame and look for a divergence at this level. And then you could trade a breakout, a moving average pattern, maybe a pullback. You could add a pivot point, whatever. But this is just a general idea. If you're struggling with creating strategy ideas, this is just a structure and a framework that you can use to guide your decision making. And of course, there are just so many different ways how you can go about this, as we will see. And then once we have our entry rule, we also need to think about our stop loss and then also the target, the management, and the exit. And all of those things need to be defined, and then you can take it to the backtest. And when it comes to choosing all of those confluence factors, the entry rules, the stop loss rules, the target rules, what I would recommend is that start with around 1 to 2 higher time frame confluence factors and maybe 2 or 3 lower time frame ones. This is especially important for your entry. What I've often seen is that traders have way too many rules or confluence factors, so they may end up with 6 or 7 things that they need in order to get into a trade: a moving average crossover, a specific candlestick pattern, the perfect lower, higher time frame, and something else. And I would recommend to limit the amount of confluence factors to a handful in the beginning, especially when you're starting with a new strategy idea. You want to keep it as simple and as basic as possible. And on the other hand, there are also traders who have too few, and then it also becomes a problem. If only you're looking for a moving average crossover, that's not going to make you money long term. This edge has been probably exploited too much. And also there's too much discretion then around the entry. You have to be precise enough so that you will be able to find similar trades over and over again. So this is a balancing act, and I will show you when we get to the process and when we do it together how to do that. Also, we can take a look at discretion versus objective confluence factors. When we talk about discretionary confluence factors, or when we just generally say we are trading discretion, what does it mean? It means that we are flexible with our rules. So for example, one of the rules could be that we have a support and resistance level. But support and resistance is not 100% objective. There are different ways how you can draw support and resistance across the different time frames even. Do you look, or what do you do with wicks? What do you do with bodies? How do you draw the support and resistance level? How many touch points? How do you deal with violations? So those are things where it's not 100% clear how a support and resistance level is created. There's no one objectively correct rule for drawing a support and resistance level. And if you ask 10 traders, you will likely get 10 slightly different answers. So that's what we are referring to with discretionary tool. And price action and candlesticks also fall into that. Trend lines as well. Waves, how do you count waves? How do you look at the pattern? How do you find discretion? How do you find them? On the other hand, the opposite is objective. And objective tools are non-negotiable. Every trader, when you have your 50 SMA on your chart, every trader will have the same price for the SMA. Every trader will have the same RSI, high or low. Every trader will have the same pivot point. Every trader will have the same high or low of yesterday's price action. And those are 100% objective tools. There's no room for interpretation. And what I found in my own trading, but also especially when I've done this strategy development with other traders, is that the best way or to counter some of the weaknesses of a fully discretionary strategy is to have at least one fully objective confluence factor in your strategy. That's what I always would recommend. For example, a pullback into a moving average. For example, an Ishimoku cloud cross. For example, a move into a Keltner channel. The Keltner channel is always going to be the same. There's no room here for interpretation. The Bollinger Band is always the same. Pivots are always the same. Those things are very helpful, and you will see that as a new and struggling trader, or just as an inexperienced trader who has never done strategy development, you will greatly benefit from having at least one objective confluence tool, because the more discretion you have in your trading strategy, the more room for inconsistencies are there. And especially new traders, if you are not used to making consistent trading decisions, you are likely to interpret support and resistance, candlesticks, patterns differently each time. And then you have a lot of noise in your system. And to avoid some of the noise, it can be helpful to have objective tools. And also what I would recommend is that once you have all of your entry rules, all of your stop loss rules defined, turn it into a checklist. I got this idea from Marty Schwartz, and he has a great book. The book is called Pitbull Champion Day Trader. And he said that he has a checklist, and he reviews his checklist every time he's about to enter a trade. And this is a great way of making your decision making a little bit more objective, and also to check yourself to see, are you actually adhering to the rules, or are you currently breaking your rules? So it could be a very simple checklist. You can print it out, what I would recommend. And then just before every trade, just go through the checklist and make sure that you have everything that you need for the trade. Step 3 is then the actual process of backtesting. What is backtesting? And when we talk about backtesting, it means that we are taking the trading strategy ideas, the framework that we have developed, and we are using it on historic price data. So for example, we could go back to the price action from 1 or 2 years ago. And then from there on, we're gonna look, how would this strategy have performed on the price action? And then we can estimate the profitability. Would the market, or would the strategy have made money on the price action that we've seen over the last 6, 12, 18, 24 months? And that is then what we're doing here with the backtesting. And how to do backtesting? First of all, you have to make sure that you have all the trading strategy parameters defined: entries, stops, targets, and so on. Then you choose a market, forex, stocks, and specific instruments, and the period. How long do you want to go back and test the strategy? For a lower time frame day trading strategy, you can go anywhere between 3 and 12 months of past price action. In the next video, when we're going to do the process together, you will see that we are trading a day trading strategy for 3 months of past data. And I will show you how to estimate it. What is a good time frame? If you are trading a swing trading strategy on the higher time frames, you should test at least 1 year of price data, because if you're on the higher time frames, you will get fewer trades, but you still want to make sure that the backtest you have gives you an accurate performance overview, or at least estimate. So you want to make sure that in your backtest you have enough trades. At least I would say 30 to 50 trades. That's the minimum amount you want to get during a backtest. And that's how you can choose how far back you want to go. Also, I would recommend to test a strategy across a handful of instruments. For example, you can test a strategy on the Euro US dollar, British pound US dollar, New Zealand US dollar, and maybe something uncorrelated like the British pound, Swedish krona, something like that. But you want to make sure that you test the strategy on a few different instruments to get an idea of how the strategy performs on different instruments. Is it better on some? Does it work on all? Doesn't it work on any of the strategies, on the instruments that you traded? You can even take a strategy and test it on Forex and stocks, or Forex on crypto, for example, and then evaluate the performance. Tips: I would always recommend that you collect screenshots for each trade that you backtest. And I will show you this exactly in a moment why this is so critical. And I would also recommend do not replay the same market too many times. There's a mistake that I see many traders make, and I made it in the beginning. For example, I tested different strategies on the Euro US dollar, and at some point I tested and I went through the past history of the Euro US dollar so many times that I kind of knew what to expect, and that also is going to skew your backtesting results. Be very strict during your backtest because the live results will always be worse. So you have to be critical with your backtest. The backtesting results will never lead to the same live results. So the backtesting results will always be better than what you're going to achieve when you take the strategy live and trade it in the actual markets. So during the backtest, be very, very strict. If in doubt, lean a little bit more during a negative side. So if in doubt, is this a good trade, yes or no, count it to the no side. And if you're unsure, it's always better to leave good trades out of your backtesting results and not to skew the results. I will show you that as well. Keep good records, and this will make your backtesting more efficient. Very often, if we plan ahead, we can test 2, 3, 4, maybe even 5 strategy ideas at the same time, and so speed up the process significantly. And that's where we're going to plan ahead. Step 4, we have done the backtest now, and now we are looking at our backtesting results. And then we have to ask yourself, at the first glance, is the strategy profitable or not? That's the most important first question. And if the strategy is just barely profitable, then I would not recommend to keep going with the strategy in a live market. Because if you're just barely making money on a backtest, then very likely, because the results will be worse during your live trading, you're going to end up with a losing strategy. So here it's time to think about how could we improve this strategy to make the barely profitable strategy into a very profitable strategy. I would also recommend to discard and not continue with strategies that have a very high negative return. If you see that this is not working out at all, then I would not keep going with that. You could think about maybe how can we reverse the strategy. For example, if you trade a Bollinger Band spike and it is losing money, why not think about how could we take the opposite signal, maybe a Bollinger Band continuation, and explore that. And I would keep working on strategies that are maybe slightly profitable and see how we can improve it a little bit further and then go to the forward test. Also, it's important to ask, does the strategy meet your objectives, the objectives that we defined in the beginning? So how many trades do you get? Do you get enough trades? Is the win rate acceptable? Is the holding time okay? Do you have to hold trades over the weekend, overnight? If this is something that you didn't want, you have to probably also discard the idea. And also, are the swings, losing streaks acceptable? So we could end up with a very profitable strategy or with a slightly profitable strategy, but then you have losing streaks that go on for days or weeks. And you have to think about, are you going to trade such a strategy? And what does it say about the strategy performance? And then once we have done the analysis, it's time for adaptation. So here is where we make a change to an existing strategy. So what we can do is then we go back to our framework and we have our rules. We have everything defined, entry, stops, targets, management. And in the adaptation process, we want to see how does one change impact your performance. So for example, maybe a different entry rule, maybe a different stop loss rule. For example, we could have a smaller or a wider target, stop loss, same for target, a smaller or a wider target. We could change from an active to a passive management. We could have a very different exit rule. And that's what you do in your adaptation process. And the most important thing is here that we want to limit the changes to one at a time. You don't want to change your entry, your stop loss, and your target at the same time and then see what happens. Because then, if the strategy that gets better, you don't know if only one of those factors is the reason, or is it the combination on all of them, and then you are left a little bit unclear. But if you, for example, only make one change and only change the stop loss there, and your strategy gets better, then you know, okay, the stop loss change is actually helpful. It made the strategy better, and that is what you want to see, and that's what you want to get at. You want to find out what makes the strategy better, what makes it worse. And to do that, you have to make only one change at a time. That's the key here in this process. And what can we change? We could change the time frame, which will increase, or change the holding time, how many trades you have, and also the screen time, how requirements, how long do you have to be in front of your screen. You can also change stop loss and take profits distances. Here often this doesn't even require a new backtest if you are smart enough and plan ahead. I will show you how to do that. Entry, we could change and add a new entry condition. We could remove an entry condition. We could change the management. Here also we don't usually need a new backtest. We can just replay our results and look at our results, interpret them differently, and then we have the answer. And there are a lot of huge time savers here in this process, as I will show you. And the adaptation process follows this framework. So here is step 1, or step 2, where we have our framework. Then we backtest it. Then we evaluate the results, and then we make our change. We make one change, then we have our new rules based on the change. Then we test it again, evaluate it, maybe make one more change, and at one point you're either going to take it live, trade it in a forward test, or discard the strategy and do something new because it's not working. And the question then is always, when is it time to go live? So first of all, if the backtest is not passed and you're not making money in a backtest, either you adjust the parameters or then you backtest again, but you don't take it live if your backtest is not passed. If your backtest has passed, it is making money, your strategy objectives are met, then you can think about taking that live. That makes sense. If your backtest is not profitable, it doesn't make any sense whatsoever to take it live. When to abandon a trading strategy? So that is very critical. At one point, I've seen many traders spend way too much time developing strategies that just don't seem to go anywhere. And usually you're better off to just throwing in the towel, cancel, or not pursuing the strategy anymore, and then developing something new. So when your backtest is showing a very negative performance, I would not continue with the strategy. If you're tweaking the strategy, so you're making maybe 1 or 2 changes to it, and it doesn't change the performance, also abandon it. The strategy stops working and does not generate profitable results anymore. So what this means is maybe you're testing 12 months of data and the strategy is making money for the first 3, but then the last 9 months it's not making money anymore and it's losing consistently. That's not a good sign. Even if the first 3 months would have been so profitable that you would still end up with a profitable result overall, I would not continue with the strategy. You want to make sure that the strategy works reasonably well across a long sample size. You want to see that the strategy doesn't have those huge fluctuations. And also if your strategy cannot meet any of your objectives, then also it is time to abandon the strategy. This is a quite interesting question I often get. One versus many strategies. What should you trade? What is the best way? And there are different answers and it's a complex topic, right? But what I would recommend in the beginning, if you are new, if you have not mastered a trading strategy, or if you have not seen a progress or in your strategy, then don't spread yourself too thin and don't start creating new strategies. It's always recommended in the beginning to first try to master one strategy. And that is the key here. You don't want to overwhelm yourself with the new task of then also developing new strategies at the same time. And once you have made one strategy profitable, then you can add a second one. And how do you add a second strategy? It could be either a one that is similar to the one that you're already trading, but then the correlation will be high, or you add a strategy that is very different to the one that you are already trading. And here we may be able to benefit from diversification benefits. But it can also be mentally harder to trade different strategies because sometimes you may have conflicting signals. That's very important also to keep in mind when you develop a strategy, you can ask yourself, okay, what is my current strategy? What are the parameters? Is it a swing trading? Is it a trend following? What is it generally? And then you can estimate, okay, the strategy that I am developing right now, is it very similar or is it very different? And that will give you a good idea of which direction you're going. And the cool thing is about this is that you will benefit from a portfolio effect. So here I have 4 different trading strategies. All have been backtested for 10 trades. And you can see the results are overall mixed, but not great, right? But what happens if we can combine them in one trading portfolio? If we would just sum up all of those results, we would end up with this, which is obviously much, much better than each of those single individual performances, right? And that's the beauty of trading uncorrelated trading strategies. So if one strategy is underperforming, another strategy may be better performing. So here, for example, this strategy in the beginning was underperforming, but this strategy in the beginning was really nicely performing. And then this strategy in the later part underperformed, but this strategy then had a much better time. So this is really, really nice to see in action. Maybe you have a day trading strategy and a swing trading strategy, and at some point this day trading strategy is performing better. Or maybe you have a trend following and a counter trend or reversal strategy. In some periods, the trend will perform better. In some periods, the reversals will perform better. So if one strategy is underperforming, another strategy may help out here and help you still realize a good overall performance. So that is where ultimately you want to end up as a trader. Not in the beginning, but this is something to plan ahead for your trading career, that you may want to look into creating a portfolio of 3, 4, maybe even 5 if you can handle it, trading strategies, and then trade them side by side and really benefit from this portfolio effect. And now the next step is that we're going to do this live in action. So we're going to do all of those 5 steps together with a trading strategy idea that I want to test, and I will show you how to do this.